back with the market right here in 80 now. After a day's break, we're all set to open today. Just want to mark what the adjusted SGX Nifty rate is, because after holding higher by about 150 points, it settled in about 100 odd points higher for now, and this after a rebound of almost 200 points that we saw in Tuesday's session alone. We made it back to that 14,541 mark after breaching almost 14,300 also in Monday's session. A bit of a bounce coming in from there, and on Tuesday we nicely built on to that. But what's in store for us going forward, given that the spike in the corona cases is not just now restricted to states like Maharashtra, New Delhi, Uttarakhand, Jharkhand, Rajasthan. There are many states which are reporting a spike in the corona cases. Let me welcome on board Dipen Mehta then and talk about what he's making of the market this morning. Dipen, hi, good morning. Good to have you on the show and hope all's safe with you. Just wanted to understand, Dipen, that would it be foolish to assume that with Monday's price action, the damage is already penciled in? Because the worry is that not just Maharashtra, but other states as well are reporting a spike now. If they too were to go into lockdown, much like Maharashtra, markets may see further damage.
Good morning and thanks for having me. You're right. I think that we are again back in uncertain territory. And the blue sky scenario is no longer there as far as markets are concerned. We do not know which states will take what action, what impact that will have on the economic activity over there. But I think we are in for a few rough months at least, if not a few weeks, where certainly economic activity will get impacted. And more than that, I think consumer sentiment, investor sentiment will certainly take a hit on this count. So as long-term investor, I think you just have to ride out this period of uncertainty and look for better times once all this again settles down. And it will settle down as we have seen in the past, that once the lockdown starts to take impact, the cases start to come off and then again the confidence comes to reopen the economy. So I think one thing is clearly understood and concluded is that these are temporary phenomena and do not have much of a long-term impact, I would say multi-quarter, multi-year impact on consumer spending or economic activity or a capex cycle for that matter.
Sure. Dipen, Infi, TCS, both numbers out. Infi reported a muted set. You had the ADR down about almost 6% as well overnight. And then TCS as well saw a very bleak reaction to its earnings on Tuesday, wherein the stock fell by about 3.5%. What is it that you're making of the near-term growth in the IT big boys, and whether or not it's already penciled into the stock prices?
Yeah, I think both Infi and TCS entered into their earnings on a strong note, and there were certain chinks in what they reported, minor disappointments. At least it did not beat the consensus estimate by margin resources, of course, was below consensus estimate. But these are complex businesses and you could have a soft quarter once in a while, but the long-term prospects do not diminish on account of that. We have seen very strong deal wins coming in for both TCS as well as Infosys. And what that does is offers multi-year visibility of earnings. And with the kind of forecast that the management has made, the guidance which they have given, we can safely factor in at least 12 to 13%, 12 to 15% type of top line and bottom line growth for the next 3-4 years for the two large companies, TCS and Infosys. And that kind of brings secularity into earnings and also gives comfort to investors to give a higher PE multiple for such businesses. And I think that as long-term investors, one should focus on that. I do feel that these companies are at a stage where even if PE multiples do not expand, which I think they should expand because of certainty of earnings, you could still see them delivering 15-17% type of compounded returns over the next 2-4 years or so. And that's quite reasonable and quite attractive in times like this. Also, software companies remain a safe haven, and if the corona situation were to deteriorate in India or globally, these are certainly very safe havens to hide at this point of time. So I wouldn't be too negative on technology, and I would say that corrections like this are good opportunities for investors who are underweight software to at least try and get equal weight, if not overweight.
on with us, Dipen. Lots more to talk about, but let's also talk about the implications of this second wave that is tormenting India. William Foster, Moody's Investor Services, now joins in on the show. William, good to have you on board. Now, to begin with, your latest report seems to suggest that this second wave of the COVID poses a credit negative risk to economic recovery. Could you quantify how much of an impact this could potentially have on economic growth?
Well, I can't quantify it right now. We're going to be basically monitoring the lockdowns at this stage and the spread of the virus to get a better sense as to how to quantify it and to ultimately revise our GDP forecast accordingly. But we're at the very early stages of this, obviously, and what we're seeing was, obviously concentration of the spread of the virus in Maharashtra, which is an important economic center, but now seeing it more broadly in other states, and it's happening very quickly. So to try to capture that, the economic impact at this moment is very difficult because there are many different scenarios you can play out, but it's clear at this stage that the impact will be more negative than the forecast we currently have, which we're expecting an acceleration and not anticipating a second wave, as we had been forecasting about 13.7% real GDP growth for this fiscal year, and obviously there's significant downside risk to that at this stage.
And add to the mix rising inflation as well, William. How much of an impact is this going to have in terms of pressurizing growth across the globe, that is?
I think the extent to which that could be a headwind to growth really is if the RBI were to respond with less accommodated monetary policy at a time when you have growth pressures because of the conundrum of higher inflation. But at this stage, I think it's again, if you do have enough pressures on growth and in terms of headwinds to the recovery, because of the virus, I would imagine the RBI is going to take that obviously in consideration and try to weigh the cost benefit of higher inflation. But it does make it a more difficult decision from a policy perspective when you have these inflationary pressures that may be rolling on top of the emergence of the second wave.
Sure. William, as long as the Fed and central banks maintain the easy policy, do you think India will be a gainer in terms of fund flows?
Well, certainly, we expect the Federal Reserve to maintain interest rates around where they are today and for at least the next 2 years, and that's what they're continuing to forecast. We believe that will be the case. We believe there will be a jump in inflation based on just pent-up demand being released. But we think that overall rates will remain low. To what extent that can benefit other countries really, I think, will in large part also depend on just the overall outlook for growth in those countries and recovery from the shock from COVID. The U.S. is experiencing right now is the beginning of what we expect to be a very strong recovery and growth. But if we're seeing second waves around the world, I believe that what we're going to need to see most likely is a emergence from that and clarity that this is going to be with vaccine rollouts and ultimately with public health responses that are effective. That will then, I think, pave the way for stronger growth and benefits from lower interest rates. But the public health response is really critical at this stage to prevent the widespread of the virus in the second wave.
Sure. India was expected to grow faster in FY22, but now with the second wave, how do you think that is going to change, and what is the risk on the fiscal deficit that we run?
Well, with regards to the deficit, we think that the budget laid out what we think is a relatively transparent and achievable deficit, provided growth does pick up the way that we anticipated. I think the government in the budget was expecting nominal GDP growth around 14.4% or so. That translates to real GDP growth probably around 10 or 11% or so, and that's what the government has been forecasting. We think that's achievable, but this risk of the second wave really creates potential scenario in which that will be more difficult to achieve the deficit reduction that they have been pointing to, mainly because that would result in a situation where expenditure might have to be diverted away from capital CapEx, as it had been intended to in the budget, toward more public health response. With lower growth, you'd have lower revenue generation, and that would put some pressure on the budgetary outcomes. But I think it's definitely too early at this stage to start forecasting any changes on that front, because we really just don't know to what extent this second wave will play out as the duration of it and how acute it will be. Hopefully it will not be, and if that's the case, I think we'll be maintaining our forecasts that are in line with what the government had been indicating in February in terms of deficits.
Right, William, finally, could we expect some sort of a lesser impact or some sort of a cushion to the economy this time, given the fact that there is a focus on micro-containment zones to deal with the curfew and the infections which are rising?
Well, if you look at other countries around the world where you have a lot of work at home that's going on, it's certainly been very helpful that this is a trend that had already started obviously before COVID, and it's been a very, very helpful for businesses that can do that. But, I think what we have to remember is that there are many other businesses where that's not the case. Certainly when you have more informal economies like you have in India, when you have a high concentration of jobs in services sector that are not geared toward this, where people consume actual need to leave their homes to consume these goods, like restaurants or going to get your haircut, things like that. And so, to the extent which there's a concentration of jobs and livelihoods in that sector, which certainly is the case in India, it's going to be harder for the overall economy to perform as well as it could have if you have to continue to rely on at-home jobs, because that's just not the structure of the economy is, in terms of overall livelihoods, is not supported by those jobs, even though they are high productivity and contribute to growth. So I think we need to keep that in mind.
All right, William, we'll let you go on that note. Appreciate your time. Thanks very much for joining in. Dipen, to get right back to our conversation, wanted to understand from you, it's been quite interesting in the primary markets as well. Macrotech developers or Lodha, there was Nazara Tech. We also had, a slew of other IPOs hitting the market, Kalyan Jewelers, etc. Has there been anything that you, believe has merits a mention in terms of long-term potential, that investors who put in their money in the IPO should be sitting pretty, or those who missed the bus definitely need to relook these stocks?
I think that certainly we've seen a slew of new IPOs, but the most interesting one that comes to mind, and we should disclose that we are invested in it, is Nazara Technology. And considering that gaming per se is a larger market than even OTT and all other forms of entertainment, I think that a company like Nazara has a great future. And although at present it is still in a growth mode, it's still building its businesses, because of which there are hardly any profits to show for. But at the end of the day, I think in 3-4 years' time, this will be a solid value creator. Overall, I think there is a great jump as far as the use of its products are concerned and services are concerned. I think eventually that will start getting factored into the valuation of the company. Also, typically businesses which are one of the kind, a bit of a concept business, who tend to get market fancy, and we expect this company and business to trade at rich multiples going forward. So I think that a correction like this is a good opportunity to get into something like Nazara Technology, which offers quite a different type of investment theme, which otherwise is available only in the private space.
When you say Nazara, Dipen, good morning. Nazara reminds me of what Info Edge is trying to do. Info Edge essentially had a steady business which is Naukri, and then they had a lot of other investments in Zomato, Policy Bazaar, which actually really gave them strong cash flow. Nazara, I think, is also trying to do the same. Rather than being a original gaming content creator, they're investing in a lot of companies through the cash flows.
Yeah, good morning, Nikunj. I think that's a sound strategy. I think you've seen the way value has got created in Info Edge. And as of now, I think Zomato is the largest component of the valuation as far as Info Edge is concerned, and something similar could play out for Nazara. So I think from that point of view, investors have that comfort and have that outlook that eventually it will be quite a large company with stakes, minor as well as major, and several other smaller gaming companies. And in a way that de-risks the business and also provides good visibility as far as earnings are concerned. So I think that whatever strategies this company follows, eventually I think because of the size of the market, because of the size of the opportunity, you will see growth coming through in a very strong manner over the next few quarters and years. And I think that eventually will get reflected in the stock price.
Dipen, we spoke about BPCL last time. Are you still confident that despite COVID concerns and what's happening, it's a sound buy, the transaction could go through?
Well, it's a big if at this point of time. And the big disappointment as far as BPCL was concerned is that none of the oil majors have put in the hat for acquiring the company. And that does show that maybe the business is not as attractive as we thought earlier. And if private equity players are going to acquire BPCL, then in a way, I mean, they will try to unlock the value. Yes, certainly, but the long-term prospects of the oil refining, oil marketing business does need to have a relook at this point of time. And end of the day, I think any appreciation in BPCL is now linked to its privatization, how that takes place, what price it takes place, what's the open offer, how that gets accepted. So there's just too many ifs and buts, and while a lot of it may do in a bull market when all stock prices are moving up, but in times like this, when we are in the midst of a rather severe correction, I think it's better to focus on quality businesses which you have missed earlier, which may have corrected 15-20% from their highs, nice growth businesses with good visibility, good corporate governance, and get into those quality businesses rather than something which is dependent on an event. And if that event were to not take place, then the overall business is not that exciting or attractive. So I think this is a time to improve the quality of the portfolio and not try and dabble in speculative trades.
Insurance stock, while banks have been on the receiving end and banks have got completely chopped out, especially corporate facing banks, smaller banks like RBL, let's look at insurance stocks, HDFC Life. We can talk about the way SBI Life has moved, ICICI Lombard, a bunch of insurance companies now, Max Always, now that Axis ownership is there. Dipen, I'm trying to just bring out an important aspect, Dipen, here. Because of COVID crisis, all of us have become more conscious, and which means conscious and scared. And when you're conscious and scared, as a product you buy as insurance. Is that an underlying thought which an investor should try to, in a sense, amplify and buy into insurance stocks? I don't mean this in a perverse manner, but I'm just trying to talk about something which is obvious and real.
Right, Nikunj, I think that certainly is a thought process, but in a way it is an oversimplification of the present scenario that we are facing. And certainly, while the opportunities are better for insurance companies, it is that the valuation discomfort is what prevents us from taking new stakes or doing overweight in the insurance sector. So I would say that, certainly they have an opportunity, both general insurance as well as life insurance. But a lot of the positives have got discounted, and mind you, insurance businesses are complex businesses to understand and value. And intuitively, we do feel that using traditional valuation methodology, we are on the expensive side. And corrections like this, I reiterate, are great times to get into solid businesses, which earlier you thought their P multiples were too high. This is now a correction has taken place, and now they may be available at reasonable valuations, and the margin of safety is also come in. So I would like to go for such businesses than insurance, which are truly very long-term businesses, and they will grow steadily, but a lot of the future growth has been captured in the stock price.
Right. Okay. Let me also shift focus and let's take it across to Vivek. Find out what brokerages are now saying about the cement sector.
Well, JP Morgan has written a very interesting note as far as the cement industry in India is concerned. They've done a deep dive analysis of how exactly cement dynamics are working out, and what JP Morgan has to say is that number one, most of the cement stocks have been quite resilient and in fact have outperformed most of the other sectors despite the volatility that we've seen in the markets. Now, according to them, they believe that at this point of time, earnings for this particular quarter could be quite good, and in fact, you may see slight upward earnings revisions as well. However, the one thing that they're quite wary of at this point of time is the fact that most of the cement stocks no longer are trading at inexpensive valuations. In fact, most of the stocks are trading at much higher multiples compared to their previous highs. Now, when you're talking about their key preferred names as far as the entire space is concerned, Ultratech Cement is the stock that they're liking at this point of time. The company, according to them, is trading at 13 times FY23 EV to EBITDA versus a historical average of close to 16 times. Also, the other thing that they're noting is that most of the East-based cement companies actually would be able to provide a much higher delta in terms of earnings in the fourth quarter, given the fact that pricing as well as demand has been quite resilient over there. And one more important space, and two companies that they speak about in depth, is ACC and Ambuja believe that the catch-up trade in terms of earnings as well as valuation is something has played out quite significantly. They believe that at this point of time, the potential merger isn't really on the cards, and it is still some further time away.
Okay, Vivek, we'll leave it at that. In fact, CLSA has come out with its latest note on Tata Motors as well. Let me take it across to Vinny, find out what they have to say.
So CLSA has maintained a buy stance on Tata Motors with a target price of 425 rupees per share. Now, JLR mix improvement has continued for the company, so surely some positive signs over there. As well as the Land Rover's volume share rises to 81% in Q4 versus 78% in Q3. So surely improvement coming in over there, improvement in JLR mix, and overall JLR's performance outperforms its peers in China as well. So surely it's a big market. JLR is a big market, has a big market in China, so surely signs of outperforming its peers is surely a positive sign for the company. And the EO's underperformance due to Jaguar electric vehicles volume share is at 9% in Q4 FY21. So surely the company has highlighted this facts, but the improvement mix from JLR is surely a positive for Tata Motors. Now, overall, the value of the India business is at rupees 185 per share, while JLR is at 250 rupees per share. So let's keep an eye out on Tata Motors, given the CLSA's note and how they are maintaining the buy stance of the company.
All right, thanks very much for those details. Well, let's get a move on then, and Kunal, discuss some of the Adani group of stocks. It's been quite a fiery ride for the most part. Adani Total Gas, incidentally, the market cap is greater than that of Gujarat, IGL, Petronet, GSPL, etc. But just purely basis the chart patterns, is there any group within this basket, or rather any stock within this basket that you would advocate a buy even at the current levels?
Not really, Avan. I think the risk reward is not favorable for entering into these stocks. So yes, in terms of momentum, the momentum is extremely strong. When you look at the charts for Adani group of stocks, hardly any phase of a correction, and I think I would be of the belief that many of these stocks have managed to break out of multi-year resistances and start a trend for themselves on a much stronger basis. But then when you enter into a trade, you look out for risk reward. You just don't look out for plain momentum and then get into the momentum without even sensing that what could be the high potential target, and more importantly, what could be the risk associated with those kind of trades. So I think in that aspect, it doesn't fit well the kind of risk reward for many of these Adani group of stocks. If there is any significant correction into the stocks, like for example, I think Adani Total Gas hit a level of 1200 and the stock is now at 1020. But when you look at it in the last, even on the YTD basis in the last 3 or 4 months, the stock has risen from 350 levels to 1200 kind of zone. So correction of 100 points in a matter of a rally of almost 700 to 800 points is not a meaningful kind of a correction. So these stocks have to provide a significant amount of correction for them to come back to some kind of a territory where the risk reward becomes more lucrative. So even if one has to wait patiently from those levels, it still could be a decent bet. But I think buying at these kind of levels, very high high momentum on the upside, but low favor in terms of risk reward, I think would not be a prudent trade.
All right, to the pre-open rates then this morning, and it's a little bit of a tentative start. Down 0.5% at the get-go for the Nifty, 14,429. For the Sensex as well, we're down about 250 odd points. Do remember, we did have a very tumultuous session on Monday, some amount of reprieve on Tuesday's trading session. While it was a trading off yesterday, the global cues are indicating that it could be a little bit mixed or soft. But let's find out some mid-cap trading strategies as well. And Kunal, what is it that you're picking out?
So I want to pick up IRCTC as a mid-cap name to go long or suggesting as a buy. It's interesting because the stock from levels of 2000, 2020 or just a couple of weeks back has corrected to 1600 levels. In the process of doing or going through this correction, it's formed three lows in terms of RSIs, all three of them coinciding at the same point, and the price is actually making a pattern of lower lows. So in technical terms, we call this as a setup for bullish RSI divergence. So I'm sensing that the risk reward is quite favorable for IRCTC. The stock has tapped back into that support territory of 1600 as well, which was the previous swing support for the stock. So both in terms of risk reward as well as the setup on indicators, I would expect suggest a buy on IRCTC for a target of 1750 and stop us at 1555.
All right, and Jay, your top mid-cap calls?
Yeah, I have a buy recommendation on Ipca Labs. One can buy this for a target of 2305 to 2370, and one can place a stop loss at 2080. The reason for this is the stock seems to have completed its fourth wave correction on daily weekly charts. The weekly indicators, which had actually gone into the sell mode, has come into the buy mode after reversing from quite an oversold territory. The monthly indicators are all into the buy mode. The stock has provided a very good breakout, a very clean breakout, I would rather say, from a down trend line resistance, and it has reversed from 38% retracement of its previous move. I think from here on, the wave 5 on the upside has started, and the stock is, in the medium term, the stock is likely to form a new high and move above the levels of 2500 as well. However, for the short term, 2305 and 2375, these are the two targets. One can buy this with a stop loss at 2080.
Okay, what are the pre-open rates telling you? Now remember, pre-open rates today cannot be looked in isolation because yesterday SGX was trading and SGX actually was higher. I'll go back to the auto rally what we saw on Tuesday. Tata Motors, Mahindra and Mahindra, especially Mahindra and Mahindra. Dipen, what is the right way of looking at Mahindra and Mahindra? Auto company beneficiary of rural demand or a group which is trying to reboot capital allocation with a new professional management?
I think both, they are very favorable operating environment, change of leadership at the highest level, fresh strategy coming into play, and one of the issues which investors had with M&M in terms of capital allocation, that is right center and focus at this point of time. And they have many ways they can try and improve that particular ratio. And apart from whatever earnings they come to, is actually M&M is able to improve its capital allocation and return ratio. And investors will pay a premium in terms of higher PE multiples. So it's a very interesting investment opportunity at this point of time. And Skymet's projection that this monsoon also may be very good certainly augurs very well for rural-focused companies like Mahindra and Mahindra. And overall automobile sector is picking up. They have an exciting new product range also coming into play. So very optimistic on M&M at this point of time. And I do feel that maybe the next 2-3 years or so,
And Mahindra versus Tata Motors. I mean, Maruti is just not showing momentum, so I'm keeping that away. But both Tata Motors and Mahindra on Tuesday made a comeback.
So, Nikunj, yes, both these stocks made a strong comeback. In fact, M&M was more stronger in terms of the I would say the leadership or any kind of recovery which was seen from the auto pack, because it was the first stock or the set of the first stocks from the auto sector which moved up higher, and it consistently maintained that rally for the stock, climbing back about that 700, 720, which was a bit of a resistance for M&M. Tata Motors, on the other hand, I think also played a catch-up effect. I think the rally was more stronger in the second half, both for Tata Motors as well as for Tata Motors DVR. But then when I look at this in totality for the entire auto stocks or the auto sector, the Nifty Auto Index apparently I think has made a setup of a bullish RSI divergence. Now these setups, they generally tend to occur either at short-term bottoms or some medium-term to long-term bottoms, depending on the time frame one is looking at. And then you try and look at the behavior of the stocks as well. For example, I was discussing Maruti earlier, that the stock has formed a bullish engulfing pattern for the first time in the last 3 months. Bajaj Auto has formed a double bottom pattern on the daily charts, and same is the case with names like M&M. Tata Motors apparently hit back its previous swing low of this 285 or 286, which was the previous low for Tata Motors, and it's bounced off from those levels. So these stocks are showing a very synchronized kind of a pattern, hitting back their previous swing lows and bouncing off from those levels. So I think this should be a decent trend in the making, at least in the near term. I believe M&M, Tata Motors, and these stocks can see a follow-through price action on the upside. But names like Maruti, Bajaj Auto, and Hero MotoCorp, they can see a strong bout of short covering as well.
Jay, how much more before banks they come back? Do you see a repeat of last year, which is that banks led the decline and then post-September banks made a comeback? If the fear about the second wave from a market standpoint is less, which means markets have fallen but they've fallen less, which means they will also recover and they will recover fast. Do you think banks are now reaching that point from which there should be a contra buy? Jay Tucker? Okay, I think Jay is also not there. Kunal, let's discuss bank for a minute.
So Nikunj, I completely agree. In fact, on Tuesday we were discussing this point that whether it's a prudent risk reward to enter into the banking stocks, and I mentioned two specific sectors, banking and the auto, which both of them have gone through the correction. Now, if you look at, I was just calculating the percentage drops on individual banking names, and Bank Nifty apparently has dropped from 37,700 approximately as a high on spot levels to 30,500, which we tested on Tuesday. So it's a correction of almost 19%, 19.2%, which in a typical rally, a 20% correction for a sector or for an index is actually a good starting point for short-term bottoms or contrarian buying opportunity. Now, when you look at the components of stocks in the sector, ICICI Bank corrected more than 21%, Kotak Bank corrected 15% odd, HDFC Bank has corrected 17% or 18% from its recent swing high. So more or less these private sector banks have, and I'm talking about the large cap ones specifically, have gone through their periodic corrections of 15 to 20% from their recent swing highs. So both in terms of risk reward, in terms of a setup, what transpired on Tuesday, the pickup in the Bank Nifty, the way many of these position sizing have been done, the most important phenomena which was spotted was also the option writing which was seen, or the unwinding of the option writers on private sector banks like ICICI Bank. So